All right, so today we're going to be talking about risk management. Pretty much, I was this week was pretty slow week, choppy days for the most part, and I've noticed a lot of you guys have been over trading, and it's been costing you a lot on your account. Even some of you guys blew your account, which is not good at all. Right? So usually it's okay. It's not okay to blow your account, but this is all part of the process. This is the only way you really learn how important risk management is. So, what is risk management? Risk management in the stock market, there's a strong relationship between risk and return. The greater the risk, the greater the return generally, right? So, in financial terminology, risk management is a process of identifying and assessing the risk and then developing strategies to manage and minimize the same while maximizing the returns. Traders are not really assessing the risk; they're seeing its potential plays, but there's things other than the stock itself that's supposed to be calculated into the risk. All right. So some plays might be looking good, but there are external factors that are risks to your trades that are affecting the market. Right. Some of these factors this week include the FOMC meeting. Um, what else? Rising interest rates and also market sentiment. Right. So uh, although a trade may look good, it breaks out of its technical levels and such. There are external factors that pose a risk to your trade, and this is the kind of things you kind of want to be aware about when you're taking your trades. Just a little chart over here explaining all different types of investments that you could take when there's high risk or low risk. Some high risk investments include futures, options, commodities, penny stocks, metals, gems, collectibles, cryptocurrencies, right? So these are high risk investments. Usually they're very volatile, especially options. We're mostly trading options in the group. You guys know that this is very high risk because there is possibility that you could lose 100% of your investment, right? If done incorrectly. Also, if you don't cut your losses, this is why options is high risk, right? You lose that money and it doesn't come back. Some things you want to look into when there's choppy markets or things such as this week. You could probably look into other low risk investments or moderate risk investments, right? So moderate risk investments. Here's some examples right here: stocks, growth stocks, mutual funds, index, or real estate, right? So obviously, real estate takes a bunch of money. So when things are kind of choppy like this, you kind of want to maybe you want to just go invest in stocks itself. Moderate risk is generally a stable return and a capital appreciation in the long term. Seen when the market was kind of sideways or uncertain like this, a lot of rotation into value stocks, such as consumer staples. Also, next thing, low risk investments, right? So, low risk investments, they're not going to give you as much of a return, but your money will be safer and secure from the market. So, a lot of people think that if they don't have any money invested, they're not investing at all. But it's still cash is still a position, right? So if you look here, low risk investments, cash equivalents, money market accounts, funds, treasury bills, certificates of deposits, government and corporate bonds, right? So right now, everybody's really rotating away from high risk into low risk right now because the treasury bills, the treasury yields are increasing. Oh, position sizing, right? This is the biggest issue with everybody that's kind of definitely blowing your account is position sizing. When risk shows up in your charts and anything like that, or when risk overall shows up in the market, you kind of want to size down, right? So you guys see this week, I kind of was taking a couple unclean trades. I noticed that it could be me or it could be the market. Regardless, I'm gonna lower my position size so my account doesn't get exposed to that risk, right? So position sizing refers to the size of a position within a particular portfolio or the dollar amount that an investor is going to trade, right? So if you're usually trading like say for example me, if I'm usually trading $500 to $1,500 per trade, and this is on normal days where market is reacting well to move is moving well, getting clean breakouts, getting a lot of momentum, so anything such as that, I'll be taking my 500 to 1500. I see choppy days like today, maybe instead of going 500 to 1500, maybe I'll drop my position size down to 250 to 600 or so, right? I won't be risking as much because there is potential that my trades could go against me. All right. these are kind of things you want to assess when you're looking at how much you want to risk on a trade. Um, you want to always um, analyze what's going on in the market, right? Your external factors. So investors use position sizing to determine how many units of security they can purchase, such as how many contracts, and it helps them control risk and maximize returns. All right, so why risk management matters, a little graph picture right here. Say if you have 50 wins and 50 losses, and your wins you make about $1,000 per trade, but your losses you lose 500 per trade, your total um profits off of your wins are going to be 50,000, while your losses, if you're taking your losses at $500 per trade, your total losses is going to be 25,000. Right? So 100 trades with a 50% win rate and 2-to-1 risk to reward nets $25,000 profit. Now, it's very hard to kind of calculate this with options because you have a lot of external factors. Sometimes your trades you can't get out at 50% because the stock doesn't tell you, or there's a lot of external factors with options, right? So for me, whenever I go into an options trade, automatically calculate for 100% loss. If you automatically calculate for 100% loss, then you're gonna be a lot better off, right? So if your wins are 100% or even anything more than that, you're gonna get at least $1,000 per trade, right? Whereas if your losses is 100%, you're only gonna lose 500. Now, let's say for example, you're trading with a $1,000 account, right? And your ratio is 50%, right? Your win rate. Now, if I go in with $1,000 per trade and that one trade goes bad, I'm down to zero. Whereas if I take a trade on with $500 instead and that trade goes bad, now I still have $500 to grow my account back. Right now, a lot of people with these full accounts or a huge size of their account, it's going to be very hard to make that money back once you start knocking down your account in significant amounts. This is why I recommend trading at most maybe 10% of your account. All right. Any questions on position sizing? Could you please explain what makes a better premium? I hear people say that the strike price pays better, the Greeks impact the payout, etc. All right. Uh, so what makes a better premium? So a lot of the times when you enter a trade, you'll see you'll be able to tell if the premiums are paying by looking at how the stock is trending. So if the stock moves up like a good amount and you see that, like say you get 10 or 15% return in like a slight movement up, that usually like we'll refer to that as the premium is paying a lot better than the other ones, right? So there's a lot of Greeks that come in that are involved with that. Um, one of them include delta. Delta is how much the where is it? Delta is how much premiums change every time the stock moves up $1. So I don't really pay attention to delta. Usually I just get into the trade anyways, and I'll figure out if it's moving clean or not. So for example, if AMC moves up $1, this premium for a $15 strike price will move up 34 cents, right? So it'll go from about 40 to maybe 74. Right now, I'm not looking at this to kind of judge my trades. I'm really looking at the volume, and I'm just gonna be looking at the option, monitoring my option position while I'm in the trade. All right. So the only thing that you really care about when you're selecting which option you want to choose, you want to look at which one has the highest volume. Right. Open interest is a good one as well, but most of the time looking at the one with the highest volume. Now, also when you're choosing one with the highest volume, you want to look at most of the time looking at the one that's out of the money. Right. The ones that are in the money, once the stock starts moving, you're not really going to get paid as much as the one that's out of the money. Right. In percentage wise.